The UK government is weighing a significant change to personal finance, considering a sharp reduction in the annual tax-free allowance for cash ISAs from £20,000 to just £4,000. Advocates say this move could help channel billions into British businesses, revitalising the London stock market. However, critics warn it may penalise ordinary savers, especially those relying on cash ISAs for security and short-term plans. The debate highlights the delicate balance between economic growth and protecting consumer interests. Potential impact on savers. For the average saver, this proposed reduction could have a substantial impact. Many individuals use cash ISAs for accessible, tax-free savings, often for short-term goals like a house deposit, a new car, or an emergency fund. The current £20,000 allowance allows a significant sum to grow without being eroded by tax. Reducing this to £4,000 means that any savings above this lower threshold, even within an ISA wrapper, would be subject to tax on interest earned. This could particularly affect those with larger cash reserves or those diligently saving for a substantial purchase, effectively diminishing the real return on their savings. The drive for investment in British businesses. The government's rationale centers on stimulating the UK economy. By making cash ISAs less attractive for large sums, the aim is to encourage investors to look towards other ISA options, particularly stocks and shares ISAs. These ISAs invest in the stock market, including UK companies. The hope is that a significant portion of the money currently held in cash could be redirected into British businesses, providing them with much-needed capital for growth and expansion. This influx of investment could, in theory, boost the London stock market, leading to job creation and increased economic activity. A balancing act. This policy consideration underscores a fundamental tension. On one hand, there's a clear desire to foster economic growth and strengthen the UK's financial markets. On the other, there's the responsibility to protect the financial well-being of everyday citizens. The challenge for the government will be to determine if the potential economic benefits of increased investment outweigh the potential negative consequences for individual savers, particularly those who are more risk-averse or rely on the stability of cash savings. The outcome of this debate will significantly shape the landscape of personal finance in the UK.